Hey guys and gals, it's time we share our $121,000 Tfsa dividend portfolio income for the month of April. Let's do this! As usual, before I jump into who paid us and how much, let's glance at our portfolio's dividend calendar. January, April, this month, July and October are the bigger months, and February, May, August, and November are the smaller months. The other months land somewhere in the middle. In April, we received dividends from the following 13 stocks. We'll go through each paycheck we received, adding up our totals along the way, starting with the smallest payer, not paycheck. But before we begin, I want to thank you for helping us out by smashing that like button and subscribing to follow our TFSA portfolio journey to financial freedom. And now, for our dividends. Our first and smallest paycheck received was 66 cents from Vanguard's S&P 500 Index ETF, VFV. It provides close to 0% of our total dividend income. This will never provide a huge portion of passive income for us, as it has a low yield and has a 15% withholding tax on the distribution. We have this as a growth play for us. We're also using it to diversify into the big US stocks we will not own individually in our TFSA. I think the S&P 500 still has room to drop despite the crazy rally. Its PE of almost 24 is still above historic averages in spite of what's going on in the big picture. I plan on really adding to this position if the price is right. Our next paycheck was $34.63 from our favorite bank, TD Bank. It provides us with 2.1% of our annual dividend income. It, and the banking sector as a whole, has been under a lot of turmoil. TD was the most shorted bank in the world in April. I still like it as a dividend growth play. It has a near 9% 5-year CAGR on its dividend to go along with a nearly 5% yield. It also has a relatively low payout ratio, giving it still room to grow even if the earnings are flat for the year. Also to note, TD is tied with Royal and CIBC for the longest dividend growth streak of the big 5 banks, at 12 years. And they are the best at raising the dividend. 24 of the last 25 years, 1 better than Royal and 2 better than CIBC and Bank of Nova Scotia. It is also the second oldest dividend payer in our portfolio, paying dividends ever since 1857. So after 2 paychecks, we're at $35.29. The next paycheck was $64.22 from Algonquin Power and Utilities Corp. It provides us with 3.6% of our forward yearly dividend income. It is trading above their 5-year average yield of 4.6% with a yield of 5.1%, which could indicate absolutely nothing considering how much the stock has been decimated since November. The last dividend raise was 6% and it has a negative 2.9% 5-year CAGR on its dividend. Ouch! The only good thing is that it has lowered its payout ratio to a healthy 75%, similar to Fortis. After 3 paychecks, we almost get to the $100 mark at $99.51. Next, we were paid $23 from our one closed-end investment fund, Canoe EIT Income Fund. It provides us with 3.8% of our yearly dividend income. EIT has consistently paid out 10 cents a month for 2 decades. It has a great 5-year return, much better than the S&P 500. Let's see how long this lasts. A third along the way brings us to $122.51. Our next paycheck was $85.78 from Telus Corp, a huge jump from the $67 of last quarter. They provide us with 4.8% of our yearly dividend income. Telus has been trading down and now yields 4.9%, higher than its average yield of 4.6%, which has been creeping up as time moves on. The most recent dividend raise was a modest 3.7%, bringing its growth streak to 19 years. It'll be reporting its earnings in early May. I can't wait. Telus has a 5-year CAGR on its dividend of 6.6% and a reasonable payout on cash flow, which should allow them to continue to raise the dividend. The company has a target payout of 60 to 75%. Paycheck number 5 helps us get rolling along now. We hit $208.29. Our next paycheck was from the brother of Telus, BCE Inc. at $101.70, up almost 10% from the previous quarter of $93. This now represents 5.7% of our forward annual dividend income. It used to be overweight at 8.8%. BCE has been growing dividends for 15 straight years at a 5-year CAGR of 5.1%. Its current yield of 5.9% is above its 5-year average yield of 5.3%, which may indicate it is slightly undervalued right now. Its PE ratio is above its 5-year average yield, which is a mixed signal showing it may be overvalued. PE ratio isn't the best metric for a telecom, however. Just remember, this has been paying dividends since 1881. Talk about a track record. After this triple-digit dividend, we hit $309.99. Our next paycheck was $113.95 from Fiera Capital Corp. They provide us with 6.3% of our yearly dividend income. They are currently trading far above its average yield of 7.9% over the last 5 years. This has climbed from the low 6% range just over a year ago. At the end of 2021, there was this tiny 2.4% dividend raise. This is a high-risk, small-cap holding that was performing well for some time in the past. I wanted to accumulate more during the 2020 crash, but now I'm happy I held off as I'm losing confidence that they'll actually be able to continue to grow their income in these turbulent market conditions. Their LMT free cash flow has really shrunk Q4 2022. If this keeps up, Fiera will be forced to cut its dividend with the yield now at almost 12%. Yikes. Just past the halfway mark and we're at $423.94. Our mid-cap, Capital Power Corp, paid us $130.50, about a $10 increase from last quarter. This represents 7.3% of our annual dividend income. CPX has recovered this month, bringing its yield down to 5.3%, which is near its 5-year average yield of 5.5%. The most recent dividend increase was 5.9%. That increase was a little lower than their 6.9% CAGR over the last 5 years. They have an annual dividend growth guidance of 6% through to 2025. I expect them to meet their guidance and bring their 9-year dividend growth streak to a decade. Our 8th paycheck brings us to $554.44. Next, we were paid $47.54 in distributions from Smartcentres Real Estate Investment Trust. They now provide us with 8.1% of our forward annual dividend income. They are trading above their 5-year average yield of 6.2% at a yield of 7%. With the whole banking fiasco that keeps on giving, real estate, especially office space, is under immense pressure. I maintain my position of caution about holding office space, so I'm happy I have none in my portfolio. Smartcentres has a 5-year dividend growth rate of 1.6% and shrinking, since they haven't increased dividends since 2019. Their AFFO payout ratio remains high at 89%. With this monthly distribution, we are at $601.98. Next, we were paid $149.89 by TC Energy Corp, 10% more than last quarter of $136. This represents 8.4% of our annual dividend income. It has a yield of 6.6% and a dividend growth guidance of 3 to 5% that was just reaffirmed at the end of April with the release of a good Q1 earnings report. Its most recent dividend increase was 3.4%. Its 5-year average yield of 5.9% and dividend growth streak of 22 years, along with a 68% payout ratio on FCF, makes for a good dividend growth potential moving forward. With our 10th paycheck, we are now at $751.87. For our 11th paycheck, we have our one monthly financial payer, First National Financial. We receive $50.40. FN provides us with 8.4% of our annual dividend income. It has a yield of 6.3%, which is 10% higher than its 5-year average of 5.8%. It has a 5-year CAGR on its dividend of 5.3%. First National Financial had a small 2.1% dividend increase last year. That brought it to 11 years of dividend increases. Even with the decrease in their revenue, First National still has a decent payout ratio of only 74%. Q1 results were good compared to 2022. More on that in the portfolio update. With that monthly dividend, we get to $802.27. Our next dividend was $166.86 by Bank of Nova Scotia. This represents 9.3% of our forward annual dividend income. BNS has been paying consistent dividends since 1833, the longest in our portfolio, just ahead of TD Bank. The most recent dividend raise was 3%. It is currently yielding 6.1%, well above its 5-year average yield of 5.5%. Both these numbers are very high historically for BNS. The only other time it has yielded this high as an average over the past 25 years was in the 2020 crash. It has a 5-year CAGR of 5.9% on its dividend. The US banking sector continues to have turmoil, and this is affecting the market as a whole, but especially the banking industry. Banks will be reporting earnings in May. If the numbers are bad, we may see a further sell-off. With our biggest dividend by size, we get close to 4 digits at $969.13. And lastly, the Goliath of our portfolio, RioCan Real Estate Investment Trust. They paid us a distribution of $64.62 this month. This company provides us with a massive 10.7% of our forward yearly dividend income. It has a 5-year average dividend yield of 5.8%, which is 10% higher than the current yield of 5.3%. RioCan has now raised its dividend 2 years in a row since it cut its dividend back in 2021. Similar to Smartcentres, the real estate market is under pressure, and RioCan is feeling it. Here is my one piece of practical wisdom I can share. It is best to buy when news is poor around an industry or company, but the fundamentals and thesis for the company remain unchanged. So after all 13 paychecks on the month, our grand total is finally back in the 4 digits at $1,033.75. Our 3 largest dividend payments accounted for $447.25, or 43% of our dividend income for the month of April. We are not too worried about how much income each month brings in. We focus on the portfolio quality and never want to be too dependent on any one company to help the portfolio grow in the event of a dividend cut. As you can see from the breakdown, no one industry or company dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. April was huge on the dividend front, but brought 0 dividend raises. Let's see if we can get back on track next month. Our forward annual dividend income is sitting at $7,231, down about 15% from last year with a yield on cost of 7.4%. We still have a lot of cash to deploy this year and have just started. We expect our dividend income to snowball faster as we put that cash to work. Those that follow our channel know that we see our dividends as our little minions that work hard for us so we don't have to. With our minions working harder and harder each year, we can forecast where we'll be in about 10 years. Thank you so much for watching, liking the video, and subscribing to the channel. Until next time, I'm Mr. Financial.